Welcome to the Pro Ticker Deep Dive.
Today we are diving into really an inflection point in global finance.
And it's a shift that's being driven not by, the usual headline-grabbing retail investors. This is coming from the world's largest financial institutions.
Exactly. The topic is RWA, or Real-World Asset Tokenization.
This deep dive, I think, cuts straight through the noise.
It does. The big question we're really looking at, based on all the sources, is this. What if all the friction that has plagued asset ownership for decades?
Things like slow settlement, massive fees.
Right, and the total lack of liquidity for private assets. Boy, what if that could be, just eliminated?
Imagine instantly owning a piece of a Manhattan office tower.
Or a basket of U.S. Treasury bonds,
Right.
Settled right away. That's the operational props that these institutions are finally waking up to.
And the market is absolutely validating this promise. I mean, the sheer scale of it.
It's incredible.
RWA tokenization has just surged. It went from about $120 billion in late 2023 to, around $910 billion as of November 2025.
Yeah, that's a 260% year-to-date rally.
It's hard to ignore a move that big.
Well, it's not just a move. It's a structural recognition. The core thesis here, and this is important, is that this is not another speculative crypto bubble. This is institutional capital, deciding that distributed ledger technology is, it's just a superior market infrastructure, period.
So when you look ahead,
the projections, they suggest we could see anywhere from $5 trillion to maybe $16 trillion in tokenized assets by 2030.
that kind of growth trajectory tells you this isn't some side project anymore.
No, this is the new foundation for global asset finance.
Okay, let's unpack that. The operational revolution. Because those numbers, they only really make sense if the underlying financial structure is fundamentally changing.
It is.
So for anyone listening who's a skeptic, why is RWA tokenization, existential for traditional finance? What's the friction it's eliminating?
The friction is just baked into the old system. I mean, traditional finance, it operates on a model that was designed for paper ledgers.
Right, high communication costs, everything's slow.
Exactly. We're talking about multi-day settlement cycles, the infamous T+2.
Meaning you don't actually own your asset for 2 days after you buy it.
Right. And you have entire industries built on expensive custodians, central clearinghouses, lawyers, all just to verify who owns what, and fractional ownership on illiquid assets.
Forget about it. The administrative overhead is just prohibitive.
It's impossible. So the blockchain solution, it isn't just a slight optimization.
It's a radical compression of time, cost, and risk.
Absolutely.
Yeah.
The sources lay out a clear four-pronged paradigm shift. First is speed.
Okay.
Settlement collapses from days down to minutes, or even instantly. That frees up billions in trapped capital on institutional balance sheets.
And second is cost.
Right. We see transaction costs just collapsing by 30 to 50% across the whole life cycle, from origination all the way to securitization.
That reduction alone is just pure margin expansion for every single player involved.
Which explains the institutional stampede. And third is liquidity. By allowing for fractional ownership, assets like private credit, specialized funds, or huge real estate projects.
Things that used to be locked up for only accredited investors.
Are now democratized. They're accessible to a global pool of capital.
Okay, what's the fourth point? We've talked money, we've talked time, but institutions, they really need certainty. What's the foundational piece that brings the wary money to the table?
That would be security and settlement finality. DLT, it enables instant final settlement.
What markets call delivery versus payment, or DVP.
Exactly, DVP. And this is a really crucial concept.
Okay, so tell us why DVP is such a big deal. The source material calls it the Holy Grail. Why?
Because in traditional finance, DVP needs a central counterparty, like a clearinghouse, to sit in the middle and guarantee the whole thing.
So if I send you cash and you send me a bond...
The CCP is the middleman. They intermediate that trust, and they assume the counterparty risk for 2 days. When you achieve DVP on a blockchain, the cash and the asset, they move simultaneously, instantly. You completely eliminate the central counterparty risk.
So you're basically threatening the entire business model for traditional clearing businesses.
You are. And you're creating an immutable, verifiable audit trail that regulators are, getting more and more comfortable with.
That level of efficiency, that's why this is so big. It goes beyond the usual crypto hype cycles. What's the macroeconomic context that's supporting this rotation of capital into RWA?
Well, a few things really converged after 2022. First, you have elevated interest rates. That means yield-bearing, tokenized instruments like tokenized U.S. Treasuries are suddenly very profitable.
Very attractive.
Second, you have institutional investors, particularly in private credit and private equity, and they are desperate for new, cheaper ways to find investors.
And the old channels are too slow, too expensive.
Exactly. And third, you just look at real estate. Tokenization offers a solvent, verifiable way to unlock trillions in capital that's just trapped in illiquid physical assets.
And this is all happening with a regulatory tailwind, which is crucial. It's not resistance, it's almost like a race to lead.
That's the key shift. Regulatory clarity is accelerating everything. You look at the European Union's MiCA regulation.
The markets and crypto assets framework?
Right. It's the first comprehensive digital asset framework anywhere. It provides a clear rulebook. And then you have central banks experimenting with their own digital currencies, CBDCs.
Which is basically a huge validation of the underlying tech.
It is. It validates the DLT infrastructure for high-value settlement. And then you have Asia, Singapore, the UAE. They're actively building sandboxes to become major hubs for this.
We're also seeing concrete proof points, right? Especially in the fixed income space, which has always been so rigid.
The examples are compelling. We are well past the theoretical pilot stage now. The European Investment Bank, a major institution, issued a 100 million digital bond in November 2024.
And Siemens did one in Germany.
Siemens, a corporate giant, executed a digital bond using blockchain settlement. These are compliant revenue-generating transactions moving billions onto this new infrastructure.
And the cost savings are they're profound. The source material highlighted the mortgage-backed security space, notoriously complex.
A paperwork nightmare.
And the reporting time for those assets has collapsed from 55 days to just 30 minutes on-chain.
That is just an enormous structural margin expansion. The documented cost savings were $850 for every $100,000 mortgage originated.
And when you think about the size of the global debt market...
Those basis points saved, they turn into hundreds of billions in potential shareholder value.
Okay, let's shift gears to the market dynamics. Our sources point to a clear 3-layer stratification of RWA assets. So what are those layers, starting from the bottom?
Layer 1 is the stablecoins. They are the indispensable base layer, the main on-ramp for institutional capital.
And they're huge.
Massive. Sitting at around $500 billion in market cap, and that's up 488% since Q2 of 2024. They function as the instantly liquid, high-quality collateral for all RWA activity.
Okay, I have to jump in here and play devil's advocate for a second. That big $910 billion headline number for the RWA market. How much of that is genuine transacting assets versus just that $500 billion of stablecoin liquidity sitting there waiting to be deployed? Is the growth narrative a little bit skewed by the on-ramp?
That's a really critical question, and it gets to the concentration risk we should definitely discuss later.
Yeah.
Stablecoins are the enablers, but the real growth, the real story, is in layers 2 and 3.
Okay.
Layer 1 offers that liquidity and immediate yield, 4 to 5% annually, through instruments like USDY and USDM. This is where the institutional money waits to make a move.
So layer 2 is where the institutional rubber really meets the road.
Correct. That's the tokenized fixed income segment. It's reached about $130 billion. This is where you find U.S. Treasuries and high-grade corporate bonds.
And this is where we see that real operational adoption.
This is where you see JP Morgan Chase and UBS completing cross-chain DVP transactions using Chainlink's infrastructure. It shows trust in the entire stack.
And that brings us to layer 3, the high-growth frontier, the highest beta part of the market.
Right, real estate and alternative assets. This is where private credit, commodities, and real estate all live.
And the growth there is just staggering.
An 860% growth in 18 months, up to $240 billion. You see projections from Deloitte, ambitious but feasible, of $4 trillion of real estate alone being tokenized by 2035.
The momentum is perfectly captured in that TRIZ group deal. A $300 million transaction to tokenize a 960-unit residential development in Canada.
Yeah, Project Shelf, sorry. And that's not a single apartment. That's a massive development being fractionalized.
That's the proof right there.
It's evidence that capital markets are finally structurally comfortable with the legal and the technical wrappers around these assets now.
But if we connect this to the bigger picture, it's not just about the assets themselves.
No, it's about the crucial infrastructure that makes all the transactions possible.
Exactly. The source material really emphasizes that the true winners here are likely to be the picks and shovels, the platforms, the infrastructure providers.
Right.
So who's leading the charge? Who's capturing that institutional business?
3 names really stand out. First, you have Chainlink. It commands roughly 15% of all RWA infrastructure deployments through its Oracle network.
Because institutions can't rely on unverified off-chain data.
They absolutely can. Chainlink provides that trust layer. It ensures the digital token accurately reflects the real-world asset's value. That network effect is why their throughput surged so massively. They are the essential middleman.
Okay, so that real transaction volume justifies the attention they get. Who's building the bridges between the traditional banks and this new public infrastructure?
That's where quant really gains traction. Interoperability is critical. Banks operate on private, permissioned blockchains, and they need to interact securely with public chains like Ethereum.
And Quant provides that bridge.
It's viewed as the necessary bridge for this institutional traffic. Its performance, surging 32% recently, reflects that.
And the third one, XDC Network, it's positioned a bit differently, more focused on enterprise use cases.
Yes, XDC is deeply embedded in trade finance. It's processed transactions for over 175 enterprise applications, and its utility is so strong, it's now the 7th largest RWA token by market cap.
So the key takeaway here is that the valuations for these infrastructure players,
Chainlink, Quant, XDC.
they're being justified by real transaction flows, by institutional capture. RWA trading volume is over $50 billion a day.
This isn't just speculative activity, it's real traffic.
Okay, let's pivot to the risk-reward equation. The bull case is massive. It relies on scope. If tokenization captures just 15% of global tradable assets,
Which is estimated around $700 trillion.
the addressable market is over $10 trillion. I mean, that is just a staggering opportunity.
Yes. The bull case is driven by that measurable cost efficiency. Every single basis point you save in settlement or origination, it compounds into significant value. We're also seeing huge growth in what you might call geographic arbitrage.
Oh, so?
Well, platforms like Maple, for instance, have deployed $13 billion in lending activity, specifically targeting borrowers in places where traditional credit is hard to get or just too expensive.
So it's democratizing cross-border access to capital.
Exactly, bridging massive capital gaps globally.
But, we have to maintain balance here for the listener. What are the key risks? What could derail this whole thesis?
The first risk is always regulatory backlash. While clarity is improving with frameworks like MiCA, one significant enforcement action against a major issuer could just freeze the market overnight.
And what about security?
Security is paramount. Cybersecurity vulnerabilities, whether it's a smart contract hack or a bridge exploit, they're a constant and very costly threat.
And the legal structure of the assets themselves, that seems like a minefield.
It is, and that's probably the biggest long-term hurdle. Legal inconsistency. The legal recognition of a tokenized deed is highly inconsistent across jurisdictions.
So it might be legally sound in Germany?
Or Singapore, right. But its validity, its treatment in a bankruptcy scenario that remains largely untested in many major markets. That legal friction has to be resolved for truly global adoption.
And we can't forget the concentration issue you brought up earlier.
That's the final risk. Stablecoins still dominate this market. They represent 54% of the total value. It's a deep market, but it is also still very narrow.
So if stablecoins face a major regulatory headwind,
The entire RWA ecosystem, which uses them for collateral and liquidity, it faces systemic risk.
okay, now for the advanced listener, let's look at the market signals. The things that confirm there's real conviction among sophisticated investors. We're not just looking at chart patterns here. We're talking behavioral evidence. The market cap is consolidating near $910 billion, but the volume patterns, they really suggest institutional accumulation on the dips. That feels bullish.
It is. And when you dig into the underlying infrastructure tokens, you see these specific accumulation narratives playing out. Take Chainlink. Despite all the market volatility, it's trading near key long-term support levels.
And on-chain data shows.
It shows that sophisticated whales have been accumulating. They've added tens of millions of Link to their holdings in the past year. That's not speculation. That's structural conviction.
And Quant is showing exceptional relative strength.
That subtle 2% surge, it confirms that smart capital sees this tech as essential. It's moving toward a really key bullish technical structure, which suggests the consensus is that Quant's interoperability is becoming indispensable.
And meanwhile, XDC Network, it just confirmed a shift in its market structure.
Broke above key local resistance with strong volume support. That indicates genuine buy-side interest is stepping in. And within the asset classes themselves, we're seeing rotation.
Specifically into private credit protocol.
Yes. Protocols built on platforms like Centrifuge, they're currently outperforming, managing close to $13 billion in lending. So overall, the broad RWA sector index, it keeps printing higher lows on the monthly chart.
Which confirms this is a multi-year, secular, bullish trend.
Not just a transient spike. So the final word is simple. RWA tokenization is not some future hypothesis. It is operational right now.
It's supported by institutional capital and growing regulatory frameworks.
The evidence is there. The collapsing settlement times, the massive cost savings, it all validates the market expansion we've seen.
So the opportunity for you, the listener, is really bifurcated. The infrastructure layer, the oracles, the interoperability, that offers the most durable thesis. These are the picks and shovels.
Right. And then the specialized asset classes like tokenized real estate or private credit, they offer higher potential returns, but they require a deeper understanding of those concentrated asset risks.
The cost savings are real. The institutional capital is flowing.
And all the data suggests tokenization will scale to become a multi-trillion-dollar asset class.
Which means the critical question for you to ask is not if this scales, but given that heavy concentration in stablecoins, how will true asset diversification emerge? And which protocols will be the ones to break the institutional mold and capture the full breadth of private assets? That's going to require real conviction and deep discernment.
Absolutely.
See you all in the next Pro Ticker Deep Dive.